Hey, what's up, everybody? Patrick here with 7-2 Advisors and the Main Street Money Show podcast. So, want to shoot a quick video and tell you a real life situation as far as a scenario that had a client call in, ask for my opinion. Said, Patrick, what do you think I should do? My mother-in-law is getting approached by her insurance agent and saying, hey, you need to cancel this product that you got here. And so he wanted my opinion on it, and what I'm going to do is actually run through it here. Same scenario. You as the listener, you can say, hey, I think that he should keep that policy or she should keep that policy. Let's see what you got here. So policy date was established in 1989. So this was a permanent variable life insurance policy, 1989. And the thing is, the death benefit on it right now in 2022 is $75,000. So the payment, paying $29 a month, it was purchased in, 1989. The individual was 24 years old at the time. So $29 in 1989 might have been a lot of money, but in today's dollars, that's a pretty good deal there. And so over 33 years, it's built up around $25,000 in cash value, which is pretty good amount of change there. Loan rate 5.25. So if she ever needed to tap out some of the money, so whether she needed to buy a car or something like that, she could actually borrow from herself and pay back 5.25% interest rate. So not saying she should do that, but just wanted to talk about the actual exchanging of life insurance products and sometimes if and when that's a good fit for this situation. So the new product that the agent was pitching, and so a lot of times agents are saying, hey, this is something that you need to do. You got to do this. This is really good and it is for your best interest. It's up to you as the individual, the consumer, to really make sure you're doing your due diligence to make sure you're not getting taken advantage of and making sure that you're being looked out and cared for. So one of the things that we wanted to look at is we wanted to look at the old policy. So we looked at the old policy and then we want to look at the new policy. So sometimes it's a good thing to change out old policies for new policies because the financial product marketplace changes and develops over time. So the thing is that we're going to look at, we're going to say, all right, how much is the new death benefit going to be for? And so the new death benefit for this policy was going to be a $42,000 death benefit. So how was the individual going to pay for this policy? The agent over here, was saying, all right, you need to take the $25,000 out of the cash value and buy what's called a single premium payment, $25,000. So it says 25.5 there, but 25.5 over there. So it's funny how the payment equals exactly amount of what the cash value was. Isn't that ironic? So it's not funny, but the thing is, you got to watch out for this kind of stuff. And so $25,000 was going to buy a $42,000 death benefit. So you're probably thinking, Patrick, why would anybody do that? That's the same exact thing that I thought, because I said, all right, $75,000 death benefit, you're going to use the $25,000. So one of the things is you're getting rid of a bucket that you have access to tap into if you needed it. So now you're not going to have that $25,000 because this $18,000 is the new cash value in year one. And so that's the thing that, you can't just make these switches and think that there's not going to be implications. You got to make sure that you're looking behind the scenes with a fine-tooth comb and making sure that you really understand what and where this product fits into your financial plan at. And so I talk a lot about financial planning, and that's where I say, hey, you got to make sure that the financial plan is set up and that the things that you're buying, so if you're buying a new portfolio, some type of style or some type of insurance product, you got to make sure that those products fit inside of your financial plan. So in this situation, you tell me, do you think it's a good deal to change out $25,000 of money that you could tap into and then now have $18,000? That doesn't sound like a good deal to me. It also doesn't sound like a good deal to get rid of a $29 a month payment and then basically pay a one-time payment of $25,000. That doesn't sound like a good deal to me either. And the last thing here, a $75,000 death benefit doesn't exactly sound like it's going to be the equivalent of a $42,000 death benefit. And so just so, if some of you guys actually are into this life insurance stuff, this is with paid up additions. So after about 20 years, it was only going to be like $48,000, $50,000. It wasn't much. And so what would you do? Would you cancel this policy or would you keep this policy? And just so you know, the reason why the $25,000 and $18,000 is different is because it goes to the cost of insurance and it goes to the life insurance agent's pocket. So I said, I appreciate you calling me because it gives me an opportunity to tell you what and where this does not fit into that person's situation. And that $7,000, that $7,000 there, definitely doesn't fit into the life insurance agent's pocket because it doesn't need to belong there. It needs to belong over here inside her pocket because that's where it needs to go, because this is a good product. It doesn't need to be canceled, and it doesn't need to be exchanged for a lower quality product. So in this situation, Patrick says this one is out. Double check who you're taking your advice from. Double check who's telling you to do stuff with your portfolio, and double check where and when and why people are saying some of the things that you can do. So that's it for this video. I'm going to keep on doing some of these videos and it's really showing and showcasing what comes out and what goes on inside behind the scenes in the financial industry.